Describe the elements/steps of capital budgeting. Video. An introduction to capital budgeting. View the Investopedia video. An introduction to capital budgeting. The author explains why companies use capital budgeting and details the three most common capital budgeting approaches. An introduction to corporate valuation methods. Investopedia. Defining capital budgeting. Capital budgeting is the planning process used to determine which of an organization's long-term investments are worth pursuing. Key points. Capital budgeting, which is also called investment appraisal, is the planning process used to determine whether an organization's long-term investments, major capital or expenditures are worth pursuing. Major methods for capital budgeting include net present value, internal rate of return, payback period, profitability index, equivalent annuity, and real options analysis. The IRR method will result in the same decision as the NPV method for non-mutually exclusive projects in an unconstrained environment. Nevertheless, for mutually exclusive projects, the decision rule of taking the project with the highest IRR may select a project with a lower NPV. Key terms. APT. In finance, arbitrage pricing theory, APT, is a general theory of asset pricing which holds that the expected return of a financial asset can be modeled as a linear function of various macroeconomic factors or theoretical market indices, where sensitivity to changes in each factor is represented by a factor-specific beta coefficient. Modified internal rate of return. The modified internal rate of return, MIR, is a financial measure of an investment's attractiveness. It is used in capital budgeting to rank alternative investments of equal size. As the name implies, the IRR is a modification of the internal rate of return, IRR, and as such, aims to resolve some problems with the IRR. Capital budgeting. Capital budgeting, which is also called investment appraisal, is the planning process used to determine which of an organization's long-term investments, such as new machinery, replacement machinery, new plants, new products, and research development projects are worth pursuing. It is to budget for major capital investments or expenditures. Major methods. Many formal methods are used in capital budgeting, including the techniques as followed. Net present value internal rate of return. Payback period. Profitability index. Equivalent annuity. Real options analysis. Net present value. Net present value, NPV, is used to estimate each potential project's value by using a discounted cash flow, DCF, valuation. This valuation requires estimating the size and timing of all the incremental cash flows from the project. The NPV is greatly affected by the discount rate, so selecting the proper rate, sometimes called the hurdle rate, is critical to making the right decision. This should reflect the riskiness of the investment, typically measured by the volatility of cash flows, and must take into account the financing mix. Managers may use models, such as the CAPM or the APT, to estimate a discount rate appropriate for each particular project, and use the weighted average cost of capital, WACC, to reflect the financing mix selected. A common practice in choosing a discount rate for a project is to apply a WACC that applies to the entire firm, but a higher discount rate may be more appropriate when a project's risk is higher than the risk of the firm as a whole. Internal rate of return. The internal rate of return, IRR, is defined as the discount rate that gives a net present value, NPV, of 0. It is a commonly used measure of investment efficiency. The IRR method will result in the same decision as the NPV method for non-mutually exclusive projects in an unconstrained environment, in the usual cases where a negative cash flow occurs at the start of the project, followed by all positive cash flows. Nevertheless, for mutually exclusive projects, the decision rule of taking the project with the highest IRR, which is often used, may select a project with a lower NPV. One shortcoming of the IRR method is that it is commonly misunderstood to convey the actual annual profitability of an investment. Accordingly, a measure called Modified Internal Rate of Return, MIR, is often used. Payback period. Payback period in capital budgeting refers to the period of time required for the return on an investment to repay the sum of the original investment. Payback period intuitively measures how long something takes to pay for itself. All else being equal, shorter payback periods are preferable to longer payback periods. The payback period is considered a method of analysis with serious limitations and qualifications for its use, because it does not account for the time value of money, risk, financing, or other important considerations, such as the opportunity cost. Profitability Index. Profitability Index, PI, also known as Profit Investment Ratio, PIR, and Value Investment Ratio, VIR, is the ratio of payoff to investment of a proposed project. It is a useful tool for ranking projects because it allows you to quantify the amount of value created per unit of investment. Equivalent annuity. The equivalent annuity method expresses the NPV as an annualized cash flow by dividing it by the present value of the annuity factor. It is often used when comparing investment projects of unequal lifespans. For example, if Project A has an expected lifetime of 7 years and Project B has an expected lifetime of 11 years, it would be improper to simply compare the net present values, NPVs, of the two projects, unless the projects could not be repeated. Real options analysis. The discounted cash flow methods essentially value projects as if they were risky bonds, with the promised cash flows known. But managers will have many choices of how to increase future cash inflows or to decrease future cash outflows. In other words, managers get to manage the projects, not simply accept or reject them. Real options analysis try to value the choices, the option value, that the managers will have in the future, and adds these values to the NPV. These methods use the incremental cash flows from each potential investment or project. Techniques based on accounting earnings and accounting rules are sometimes used. Simplified and hybrid methods are used as well, such as payback period and discounted payback period. Capital budgeting. What it is and how it works. What is capital budgeting? Capital budgeting involves choosing projects that add value to a company. The capital budgeting process can involve almost anything, including acquiring land or purchasing fixed assets like a new truck or machinery. Companies use different metrics to track the performance of a potential project, and there are various methods to capital budgeting. Capital budgeting is the process by which investors determine the value of a potential investment project. The three most common approaches to project selection are payback period, PB, internal rate of return, IRR, and net present value, NPV. The payback period determines how long it would take a company to see enough in cash flows to recover the original investment. The internal rate of return is the expected return on a project. If the rate is higher than the cost of capital, it's a good project. The net present value shows how profitable a project will be versus alternatives and is perhaps the most effective of the three methods. Understanding capital budgeting. Every year, companies often communicate between departments and rely on finance leadership to help prepare annual or long-term budgets. These budgets are often operational, outlining how the company's revenue and expenses will shape up over the subsequent 12 months. However, another aspect to this financial plan is capital budgeting. Capital budgeting is the long-term financial plan for larger financial outlays. Capital budgeting relies on many of the same fundamental practices as any other form of budgeting. However, there are several unique challenges to capital budgeting. First, capital budgets are often exclusively cost centers. They do not incur revenue during the project and must be funded from an outside source, such as revenue from a different department. Second, due to the long-term nature of capital budgets, there are more risks, uncertainty, and things that can go wrong. Capital budgeting is often prepared for long-term endeavors, then reassessed as the project or undertaking is underway. Companies will often periodically reforecast their capital budget as the project moves along. The importance in a capital budget is to proactively plan ahead for large cash outflows that, once they start, should not stop unless the company is willing to face major potential project delay costs or losses. Why do businesses need capital budgeting? Capital budgeting is important because it creates accountability and measurability. Any business that seeks to invest its resources in a project without understanding the risks and returns involved would be held as irresponsible by its owners or shareholders. Furthermore, if a business has no way of measuring the effectiveness of its investment decisions, chances are the business would have little chance of surviving in the competitive marketplace. Companies are often in a position where capital is limited and decisions are mutually exclusive. Management usually must make decisions on where to allocate resources, capital, and labor hours. Capital budgeting is important in this process, as it outlines the expectations for a project. These expectations can be compared against other projects to decide which one is most suitable. Businesses, aside from nonprofits, exist to earn profits. The capital budgeting process is a measurable way for businesses to determine the long-term economic and financial profitability of any investment project. While it may be easier for a company to forecast what sales may be over the next 12 months, it may be more difficult to assess how a 5-year, $1 billion manufacturing headquarter renovation will play out. Therefore, businesses need capital budgeting to assess risks, plan ahead, and predict challenges before they occur. A capital budgeting decision is both a financial commitment and an investment. By taking on a project, the business is making a financial commitment, but it is also investing in its longer-term direction that will likely have an influence on future projects the company considers. Methods used in capital budgeting. There is no single method of capital budgeting. In fact, companies may find it helpful to prepare a single capital budget using the variety of methods discussed below. This way, the company can identify gaps in one analysis or consider implications across methods it would not have otherwise thought about. Discounted cash flow analysis. Because a capital budget will often span many periods and potentially many years, companies often use discounted cash flow techniques to not only assess cash flow timing but implications of the dollar. As time passes, currencies often become devalued. A central concept in economics facing inflation is that a dollar today is worth more a dollar tomorrow, as a dollar today can be used to generate revenue or income tomorrow. Discounted cash flow also incorporates the inflows and outflows of a project. Most often, companies may incur an initial cash outlay for a project, a one-time outflow. Other times, there may be a series of outflows that represent periodic project payments. In either case, companies may strive to calculate a target discount rate or specific net cash flow figure at the end of a project. Payback analysis. Instead of strictly analyzing dollars and returns, payback methods of capital budgeting plan around the timing of when certain benchmarks are achieved. For some companies, they want to track when the company breaks even or has paid for itself. For others, they're more interested on the timing of when a capital endeavor earns a certain amount of profit. For payback methods, capital budgeting entails needing to be especially careful in forecasting cash flows. Any deviation in an estimate from one year to the next may substantially influence when a company may hit a payback metric, so this method requires slightly more care on timing. In addition, the payback method and discounted cash flow analysis method may be combined if a company wants to combine capital budget methods. Throughput analysis, a dramatically different approach to capital budgeting, is methods that involve throughput analysis. Throughput methods often analyze revenue and expenses across an entire organization, not just for specific projects. Throughput analysis through cost accounting can also be used for operational or non-capital budgeting. Throughput methods entail taking the revenue of a company and subtracting variable costs. This method results in analyzing how much profit is earned from each sale that can be attributable to fixed costs. Once a company has paid for all fixed costs, any throughput is kept by the entity as equity. Companies may be seeking to not only make a certain amount of profit, but want to have a target amount of capital available after variable costs. These funds can be swept to cover operational expenses, and management may have a target of what capital budget endeavors must contribute back to operations. Metrics used in capital budgeting. When a firm is presented with a capital budgeting decision, one of its first tasks is to determine whether or not the project will prove to be profitable. The payback period, PB, internal rate of return, IRR, and net present value, NPV, methods are the most common approaches to project selection. Although an ideal capital budgeting solution is such that all three metrics will indicate the same decision, these approaches will often produce contradictory results. Depending on management's preferences and selection criteria, more emphasis will be put on one approach over another. Nonetheless, there are common advantages and disadvantages associated with these widely used valuation methods. Payback period. The payback period. The payback period calculates the length of time required to recoup the original investment. For example, if a capital budgeting project requires an initial cash outlay of $1 million, the PB reveals how many years are required for the cash inflows to equate to the $1 million outflow. The short PB period is preferred as it indicates that the project would pay for itself within a smaller time frame. In the following example, the PB period would be 3 1/3 of a year, or 3 years and 4 months. Payback periods are typically used when liquidity presents a major concern. If a company only has a limited amount of funds, they might be able to only undertake one major project at a time. Therefore, management will heavily focus on recovering their initial investment in order to undertake subsequent projects. Another major advantage of using the PB is that it is easy to calculate once the cash flow forecasts have been established. There are drawbacks to using the PB metric to determine capital budgeting decisions. Firstly, the payback period does not account for the time value of money, TVM. Simply calculating the PB provides a metric that places the same emphasis on payments received in year 1 and year 2. Such an error violates one of the fundamental principles of finance. Luckily, this problem can easily be amended by implementing a discounted payback period model. Basically, the discounted PB period factors in TVM and allows one to determine how long it takes for the investment to be recovered on a discounted cash flow basis. Another drawback is that both payback periods and discounted payback periods ignore the cash flows that occur towards the end of a project's life, such as the salvage value. Thus, the PB is not a direct measure of profitability. The following example has a PB period of 4 years, which is worse than that of the previous example, but the large $15 million cash inflow occurring in year 5 is ignored for the purposes of this metric. There are other drawbacks to the payback method that include the possibility that cash investments might be needed at different stages of the project. Also, the life of the asset that was purchased should be considered. If the asset's life does not extend much beyond the payback period, there might not be enough time to generate profits from the project. Since the payback period does not reflect the added value of a capital budgeting decision, it is usually considered the least relevant valuation approach. However, if liquidity is a vital consideration, PB periods are of major importance. Internal rate of return. The internal rate of return, or expected return on a project, is the discount rate that would result in a net present value of 0. Since the NPV of a project is inversely correlated with the discount rate, if the discount rate increases, then future cash flows become more uncertain and thus become worth less in value. The benchmark for IRR calculations is the actual rate used by the firm to discount after-tax cash flows. An IRR which is higher than the weighted average cost of capital suggests that the capital project is a profitable endeavor, and vice versa. The IRR rule is as follows. IRR greater than cost of capital equals accept project. IRR less than cost of capital equals reject project. In the example below, the IRR is 15%. If the firm's actual discount rate that they use for discounted cash flow models is less than 15%, the project should be accepted. The primary advantage of implementing the internal rate of return as a decision-making tool is that it provides a benchmark figure for every project that can be assessed in reference to a company's capital structure. The IRR will usually produce the same types of decisions as net present value models and allows firms to compare projects on the basis of returns on invested capital. Despite that the IRR is easy to compute with either a financial calculator or software packages, there are some downfalls to using this metric. Similar to the PB method, the IRR does not give a true sense of the value that a project will add to a firm. It simply provides a benchmark figure for what projects should be accepted based on the firm's cost of capital. The internal rate. The internal rate of return does not allow for an appropriate comparison of mutually exclusive projects. Therefore, managers might be able to determine that Project A and Project B are both beneficial to the firm, but they would not be able to decide which one is better if only one may be accepted. Another error arising with the use of IRR analysis presents itself when the cash flow streams from a project are unconventional, meaning that there are additional cash outflows following the initial investment. Unconventional cash flows are common in capital budgeting, since many projects require future capital outlays for maintenance and repairs. In such a scenario, an IRR might not exist, or there might be multiple internal rates of return. In the example below, two IRRs exist, 12.7% and 787.3%. The IRR is a useful valuation measure when analyzing individual capital budgeting projects, not those which are mutually exclusive. It provides a better valuation alternative to the PB method, yet falls short on several key requirements. Net present value. The net present value approach is the most intuitive and accurate valuation approach to capital budgeting problems. Discounting the after-tax cash flows by the weighted average cost of capital allows managers to determine whether a project will be profitable or not. And unlike the IRR method, NPVs reveal exactly how profitable a project will be in comparison to alternatives. The NPV rule states that all projects with a positive net present value should be accepted, while those that are negative should be rejected. If funds are limited and all positive NPV projects cannot be initiated, those with the high discounted value should be accepted. In the two examples below, assuming a discount rate of 10%, Project A and Project B have respective NPVs of $137,236 and $1,317,856. These results signal that both capital budgeting projects would increase the value of the firm. But if the company only has $1 million to invest at the moment, Project B is superior. Some of the major advantages of the NPV approach include its overall usefulness and that the NPV provides a direct measure of added profitability. It allows one to compare multiple mutually exclusive projects simultaneously, and even though the discount rate is subject to change, a sensitivity analysis of the NPV can typically signal any overwhelming potential future concerns. Although the NPV approach is subject to fair criticisms that the value-added figure does not factor in the overall magnitude of the project, the Profitability Index, PI, a metric derived from discounted cash flow calculations, can easily fix this concern. The Profitability Index is calculated by dividing the present value of future cash flows by the initial investment. A PI greater than 1 indicates that the NPV is positive, while a PI of less than 1 indicates a negative NPV. Weighted average cost of capital, WACC, may be hard to calculate, but it's a solid way to measure investment quality. What are common types of budgets? Budgets can be prepared as incremental, activity-based, value proposition, or zero-based. While some types like zero-based start a budget from scratch, incremental or activity-based may spin off from a prior year budget to have an existing baseline. Capital budgeting may be performed using any of the methods above, though zero-based budgets are most appropriate for new endeavors. How are capital budgets different from operational budgets? Capital budgets are geared more toward the long term and often span multiple years. Meanwhile, Operational budgets are often set for one-year periods defined by revenue and expenses. Capital budgets often cover different types of activities, such as redevelopments or investments, whereas operational budgets track the day-to-day activity of a business. Are companies required to prepare capital budgets? Not necessarily. Not necessarily. Capital budgets, like all other budgets, are internal documents used for planning. These reports are not required to be disclosed to the public, and they are mainly used to support management's strategic decision-making. Though companies are not required to prepare capital budgets, they are an integral part in planning and the long-term success of companies. The bottom line: a capital budget is a long-term plan that outlines the financial demands of an investment, development, or major purchase. As opposed to an operational budget that tracks revenue and expenses, a capital budget must be prepared to analyze whether or not the long-term endeavor will be profitable. Capital budgets are often scrutinized using NPV, IRR, and payback periods to make sure the return meets management's expectations. Describe the elements/steps of capital budgeting. Defining goals of capital budgeting. The main goals of capital budgeting are not only to control resources and provide visibility, but also to rank projects and raise funds. Key points. Basically, the purpose of budgeting is to provide a forecast of revenues and expenditures and construct a model of how business might perform financially. Capital budgeting is most involved in ranking projects and raising funds when long-term investment is taken into account. Capital budgeting is an important task as large sums of money are involved, and a long-term investment, once made, cannot be reversed without significant loss of invested capital. Key terms. Common stock. Common stock is a form of corporate equity ownership, a type of security. Preferred stock. Preferred stock, also called preferred shares, preference shares, or simply preferreds, is an equity security with properties of both an equity and a debt instrument, and is generally considered a hybrid instrument. Capital budgeting. The purpose of budgeting is to provide a forecast of revenues and expenditures. That is, to construct a model of how a business might perform financially if certain strategies, events, and plans are carried out. It enables the actual financial operation of the business to be measured against the forecast, and it establishes the cost constraint for a project, program, or operation. Budgeting helps to aid the planning of actual operations by forcing managers to consider how the conditions might change and what steps should be taken in such an event. It encourages managers to consider problems before they arise. It also helps coordinate the activities of the organization by compelling managers to examine relationships between their own operation and those of other departments. Other essential functions of a budget include to control resources, to communicate plans to various responsibility center managers, to motivate managers to strive to achieve budget goals, to evaluate the performance of managers, to provide visibility into the company's performance. Capital budgeting, as a part of budgeting, more specifically focuses on long-term investment, major capital, and capital expenditures. The main goals of capital budgeting involve ranking projects. The real value of capital budgeting is to rank projects. Most organizations have many projects that could potentially be financially rewarding. Once it has been determined that a particular project has exceeded its hurdle, then it should be ranked against peer projects. Highest profitability index to lowest profitability index. The highest ranking projects should be implemented until the budgeted capital has been expended. Private equity. Private equity firms, such as NBGI, provide funds for companies unable or uninterested in obtaining funds publicly. Raising funds. When a corporation determines its capital budget, it must acquire funds. 3 methods are generally available to publicly traded corporations: corporate bonds, preferred stock, and common stock. The ideal mix of those funding sources is determined by the financial managers of the firm and is related to the amount of financial risk that the corporation is willing to undertake. Corporate bonds entail the lowest financial risk and therefore generally have the lowest interest rate. Preferred stock have no financial risk but dividends, including all in arrears, must be paid to the preferred stockholders before any cash disbursements can be made to common stockholders. They generally have interest rates higher than those of corporate bonds. Finally, common stocks entail no financial risk, but are the most expensive way to finance capital projects. The internal rate of return is very important. Capital budgeting is an important task as large sums of money are involved, which influences the profitability of the firm. Plus, a long-term investment, once made, cannot be reversed without significant loss of invested capital. The implication of long-term investment decisions are more extensive than those of short-run decisions because of the time factor involved. Capital budgeting decisions are subject to a higher degree of risk and uncertainty than our short-run decisions. Describe the ideal criteria for evaluation. Defining capital budgeting and cash flows. Capital budgeting requires a thorough understanding of cash flow and accounting principles, particularly as they pertain to valuing processes and investments. Key points. Accounting revolves around tracking the inflows and outflows of assets, capital, and resources for an organization to adhere to legal and investor expectations. When measuring the impact of assets, liabilities, and equity, it is useful to know in which situations to debit or credit the line item based upon the flow of capital. Cash flows analyses, such as the internal rate of return, IRR, or the net present value, NPV, of a given process, are core tools in capital budgeting for understanding and estimating cash flows. Cash flow analyses can include investing, operating, and financing activities. Key terms: net present value, NPV. This calculation takes all future cash flows from a given operational initiative and discounts them to their present value based on the weighted average cost of capital. Internal rate of return, IRR, a calculation that makes the net present value of all cash flows, positive and negative, from a particular investment equal to zero. It can also be described as the rate which will make an investment break even. Accounting flows. Accounting is the processes used to identify and transpose business transactions into permanent legal records of a business's operations and capital flows. The International Accounting Standards, IAS, and the Generally Accepted Accounting Principles, GAAP, are legislative descriptions of expectations and norms within the accounting field. When it comes to the capital flows in accounting, it is easiest to visualize it based on each type of item. Accounting flows. This chart is a useful way to see the trajectory of accounting flows as they apply to different types of line items. Understanding how to report each type of asset and the impacts these asset changes have on income statements, balance sheets, and cash flow statements is important in accurately depicting accounting flows. Cash flows. A cash flow is one element of accounting flows and particularly important to understanding capital budgeting. A cash flow describes the transmission of payments and returns internally and or externally as a byproduct of operations over time. Conducting cash flow analyses on current or potential projects and investments is a critical aspect of capital budgeting and determines the profitability, cost of capital, and or expected rate of return on a given project, organizational operation, or investment. Cash flow analyses can reveal the rate of return or value of suggested project through deriving the internal rate of return, IRR, and the net present value, NPV. They also indicate overall liquidity, or a business's capacity to capture existing opportunities through freeing of capital for future investments. Cash flows will also underline overall profitability, including, but not limited to, net income. Cash flows consolidate inputs from the following activities. Investing activities. Payments related to mergers or acquisitions, loans made to suppliers or received from customers, as well as the purchase or sale of assets are all considered investing activities and tracked as incoming or outgoing cash flows. Operating activities. Operating activities can be quite broad, incorporating anything related to the production, sale, or delivery of a given product or service. This includes raw materials, advertising, shipping, inventory, payments to suppliers and employee, interest payments, depreciation, deferred tax, and amortization. Financing activities. Financing activities primarily revolve around cash inflows from banks and shareholders, as well as outflows via dividends to investors. This includes payment for repurchase of company shares, dividends, net borrowing, and net repayment of debt. Describe various evaluation methods. Payback period, NPV, IRR. Defining ranking investment proposals. Several methods are commonly used to rank investment proposals, including NPV, IRR/PI, payback period, and ARR. Key points. The higher the NPV, the more attractive the investment proposal. The higher a project's IRR, the more desirable it is to undertake the project. As the value of the profitability index increases, so does the financial attractiveness of the proposed project. Shorter payback periods are preferable to longer payback periods. The higher the ARR, the more attractive the investment. Key terms. Discounted cash flow. In finance, discounted cash flow, DCF, analysis is a method of valuing a project, company, or asset using the concepts of the time value of money. Time value of money. The time value of money is the value of money, figuring in a given amount of interest earned over a given amount of time. Ranking investment proposals. The most valuable aim of capital budgeting is to rank investment proposals. To choose the most valuable investment option, several methods are commonly used. Investment proposal. Choosing the best investment proposal for business. Net present value, NPV. NPV can be described as the difference amount between the sums of discounted cash inflows and cash outflows. In the case when all future cash flows are incoming and the only outflow of cash is the purchase price, the NPV is simply the PV of future cash flows minus the purchase price, which is its own PV. The higher the NPV, the more attractive the investment proposal. NPV is a central tool in discounted cash flow, DCF, analysis, and is a standard method for using the time value of money to appraise long-term projects. Used for capital budgeting and widely used throughout economics, finance, and accounting, it measures the excess or shortfall of cash flows in present value terms once financing charges are met. NPV formula. Each cash inflow/outflow is discounted back to its present value, PV. Then they are summed. Therefore, NPV is the sum of all terms. Internal rate of return, IRR. The internal rate of return on an investment or project is the annualized effective compounded return rate, or rate of return, that makes the net present value, NPV, as NET*1/own plus ERR year, of all cash flows, both positive and negative, from a particular investment equal to zero. IRR calculations are commonly used to evaluate the desirability of investments or projects. The higher a project's IRR, the more desirable it is to undertake the project. Assuming all projects require the same amount of upfront investment, the project with the highest IRR would be considered the best and undertaken first. Profitability Index, PI. It is a useful tool for ranking projects because it allows you to quantify the amount of value created per unit of investment. The ratio is calculated as follows. Profitability Index equals PV of future cash flows/initial investment. As the value of the profitability index increases, so does the financial attractiveness of the proposed project. Rules for selection or rejection of a project. If PI greater than 1, then accept the project. If PI less than 1, then reject the project. Payback period. Payback period intuitively measures how long something takes to pay for itself. All else being equal, shorter payback periods are preferable to longer payback periods. Payback period is widely used because of its ease of use, despite the recognized limitations. The time value of money is not taken into account. Accounting rate of return, ARR. The ratio does not take into account the concept of time value of money. ARR calculates the return generated from net income of the proposed capital investment. The ARR is a percentage return. Say, if ARR equals 7%, then it means that the project is expected to earn 7 cents out of each dollar invested. If the ARR is equal to or greater than the required rate of return, the project is acceptable. If it is less than the desired rate, it should be rejected. When comparing investments, the higher the ARR, the more attractive the investment. Basic formulae. Defining reinvestment assumptions. NPV and PI assume reinvestment at the discount rate, while IRR assumes reinvestment at the internal rate of return. Key points. If trying to decide between alternative investments in order to maximize the value of the firm, the reinvestment rate would be a better choice. NPV and PI assume reinvestment at the discount rate. IRR assumes reinvestment at the internal rate of return. Key terms. Weighted average cost of capital. The weighted average cost of capital, WACC, is the rate that a company is expected to pay on average to all its security holders to finance its assets. Reinvestment rate. To some extent, the selection of the discount rate is dependent on the use to which it will be put. If the intent is simply to determine whether a project will add value to the company, using the firm's weighted average cost of capital may be appropriate. If trying to decide between alternative investments in order to maximize the value of the firm, the corporate reinvestment rate would probably be a better choice. Reinvestment. Reinvestment to expand business. Reinvestment factor. Describe how the reinvestment factors related to total return. NPV reinvestment assumption. The rate used to discount future cash flows to the present value is a key variable of this process. A firm's weighted average cost of capital, after tax, is often used, but many people believe that it is appropriate to use higher discount rates to adjust for risk or other factors. A variable discount rate with higher rates applied to cash flows occurring further along the time span might be used to reflect the yield curve premium for long-term debt. Another approach to choosing the discount rate factor is to decide the rate that the capital needed for the project could return if invested in an alternative venture. Related to this concept is to use the firm's reinvestment rate. Reinvestment rate can be defined as the rate of return for the firm's investments on average. When analyzing projects in a capital-constrained environment, it may be appropriate to use the reinvestment rate, rather than the firm's weighted average cost of capital as the discount factor. It reflects opportunity cost of investment, rather than the possibly lower cost of capital. PI reinvestment assumption. Profitability index assumes that the cash flow calculated does not include the investment made in the project, which means PI reinvestment at the discount rate as NPV method. A profitability index of 1 indicates break-even. Any value lower than 1 would indicate that the project's PV is less than the initial investment. As the value of the profitability index increases, so does the financial attractiveness of the proposed project. IRR reinvestment assumption. As an investment decision tool, the calculated IRR should not be used to rate mutually exclusive projects, but only to decide whether a single project is worth the investment. In cases where one project has a higher initial investment than a second mutually exclusive project, the first project may have a lower IRR, expected return, but a higher NPV, increase in shareholders' wealth, and thus should be accepted over the second project, assuming no capital constraints. IRR assumes reinvestment of interim cash flows in projects with equal rates of return. The reinvestment can be the same project or a different project. Therefore, IRR overstates the annual equivalent rate of return for a project that has interim cash flows, which are reinvested at a rate lower than the calculated IRR. This presents a problem, especially for high IRR projects, since there is frequently not another project available in the interim that can earn the same rate of return as the first project. When the calculated IRR is higher than the true reinvestment rate for interim cash flows, the measure will overestimate, sometimes very significantly, the annual equivalent return from the project. This makes IRR a suitable and popular choice for analyzing venture capital and other private equity investments, as these strategies usually require several cash investments throughout the project, but only see one cash outflow at the end of the project, via IPO or M&A. When a project has multiple IRRs, it may be more convenient to compute the IRR of the project with the benefits reinvested. Accordingly, MIR is used, which has an assumed reinvestment rate, usually equal to the project's cost of capital. Calculation of the MIR. MIR is calculated as follows.